Okay, have you ever felt like you're living in two completely different economies at the same time? I mean, on one hand, you're hearing all this amazing stuff about AI breakthroughs, soaring stock markets, and companies making record profits. But then you look at your own paycheck and, well, maybe it's not quite keeping up with all that hype. You're not imagining it. This growing gap is a real thing, and it's what we're here to break down. Let's dive in.
So this is it, right? This is the big question. We see AI making companies more productive than ever. We see their valuations just exploding, but for so many of us, that boom feels pretty distant. So what is actually going on here? Why isn't all this incredible new wealth translating into higher pay for the average person?
And this slide just lays it out perfectly. It really is a tale of two trends. You've got companies on one side, just killing it. Profits are up, stocks are soaring, and the output per worker is rising. But on the other side, you have the workers, where the median wage is basically stuck in neutral. It's like two trend lines that are just heading in completely opposite directions. Now, this isn't just a temporary lag in the market or some kind of weird economic blip we're seeing. The sources we're looking at argue that what's happening is something much, much deeper. They call it a structural divergence. So what does that mean? Well, the really crucial point here is that the old-school link between a company getting more productive and its workers getting paid more, that link has fundamentally broken. It's a decoupling. These two things that we always assumed were tied together are now on separate tracks, and it's a long-term shift.
And this didn't just happen overnight. The gap actually started to open up way back in the late 20th century. Then came the digital era, think software and globalization, and that gap got even wider. But the AI era that we're living in right now, it's like we've hit the accelerator. That divergence is becoming more dramatic and way more obvious than it has ever been before.
So, how exactly is AI doing this? How does it rewire the whole system for who gets the gains? It's not magic, right? It all comes down to the specific nature of this technology and how it interacts with the economy we've already built.
Okay, this is a really fascinating distinction. Think about past automation, like in a factory. That was often labor-augmenting. It made workers more productive, for sure, but you still needed more people to manage all the new output. But today's AI, it's what's called capital-augmenting. It makes the capital, the system, the software, the data itself wildly more productive. This allows a company to scale its output to massive levels without really needing to scale its number of employees.
So, why does this capital-augmenting thing have such a huge impact on our paychecks? Well, it really boils down to four key factors that all work together to drive this whole divergence. Let's take a look at each one.
First up, scalability. It's just wild. Once you build an AI system, doesn't matter if it's for writing code or creating marketing ads, you can roll it out to 10 people, 1,000 people, or 1,000,000 people for almost no extra cost. All that revenue flows directly to the owner of the system, not to a bigger and bigger workforce.
Second, it's all about bargaining power. Look, an employer basically pays you based on what it would cost to replace you. So if they can credibly say, we could probably automate a big chunk of your job, your leverage in a salary negotiation just plummets. It's the threat of AI, even if it's not fully there yet, that puts this downward pressure on wages for everyone.
Third, we've got to talk about market concentration. I mean, developing cutting-edge AI takes an insane amount of resources, right? So it's all concentrated in a handful of giant tech companies. Because there's less competition, there's way less pressure on them to raise wages to attract the best talent. They can just hold on to the profits.
And the fourth factor is the globalization of labor. AI tools are making it easier than ever to manage and coordinate work from anywhere on the planet. This basically creates a massive worldwide talent pool for a lot of knowledge-based jobs. And simple economics. When the supply of workers goes way up, local wage growth tends to slow way down.
Okay, so if all this money isn't flowing into our paychecks, where is it going? This brings us to what might be the most critical piece of this entire puzzle: the massive, massive advantage of ownership.
This slide right here is absolutely key to understanding everything. As a wage earner, your salary is basically a fixed claim. You're a line item on the company's expense sheet, a business cost. But an equity holder, a shareholder, they have what's called a residual claim. They get what's left over after all the costs, including salaries, are paid. And thanks to AI, that leftover surplus is getting bigger and bigger.
And this quote just says it all, doesn't it? The big question isn't whether AI is creating value. It obviously is. The real, decisive question is, who gets the rights to that value? Who actually owns the asset that's generating all this new wealth?
And the answer is pretty clear. The main beneficiaries are the owners of capital. We're talking about the shareholders, the company founders, the venture capital funds that back them, and even the companies that own the essential infrastructure, like the cloud platforms. They hold the equity, so they get to capture the upside.
So this divergence isn't just some abstract economic theory. It has very real-world consequences for our careers, our finances, and frankly, our society. Let's talk about those ripple effects.
So what does this all mean for you and me? Well, for one, it means those mid-skill jobs, the ones involving routine analysis, they're getting squeezed. It means a lot more career anxiety, as those stable income paths feel less and less certain. And maybe most importantly, it means that income you get from owning assets is going much, much faster than the income you get from just working a job. That makes ownership more critical for building wealth than ever before.
At the end of the day, it really comes down to this powerful idea. Technology, like AI, is absolutely incredible at making the whole economic pie bigger for everyone. But it's our human-designed systems, things like corporate governance, labor laws, ownership structures, those are the things that decide how that pie gets sliced up.
And that leaves us with this final crucial question. This isn't really a story about technology being our destiny. It's a story about the choices we make. As AI continues to generate just unprecedented levels of wealth, probably the most important conversation we can possibly have is about who gets a say in where all that wealth goes.